What if I told you that your super fund, the same one sitting quietly there and making a few percentage every year, could be buying investment properties and building your retirement wealth much faster than your super account? Sounds unbelievable, right? But thousands of Australians are already doing it, and the numbers are increasing every year. Today, I'm going to reveal how the self managed super fund property strategy really works, what most people get wrong, and how you can use it to secure your financial future. Hi everyone, it's John from Admire Property Group, and we help investors build property portfolio that grows safely and strategically. And one of the most misunderstood opportunities out there right now is investing through your self-managed super fund. That's called SMSF. In the last 5 to 10 years, investment made through the super have jumped more than 20%, and that's not by accident. Investors have realized that using the right setup, your super can become one of the most powerful tool to build your wealth for long term. In this video, I will break down how investing in property through SMSF really works, the rules and the compliances you need to know, the massive tax benefit most people overlook, and how can you structure it to grow your wealth faster than you think. So stay with me till the end, because this is one of those strategies that can genuinely change your retirement outcome. And if you find value in this video, make sure you hit subscribe and share the video with the others. It really helps us reach more Australians who are wanting to increase their wealth through smart property investing. So let's start with the first one. The first one is why most Australians are turning their super into property power. Let us start with why. Because if you don't understand why this works, you will never realize the true potential of it. When you invest personally, you are paying tax on your earnings, and sometimes it is up to 45%. But when you invest in your SMSF, your earnings and capital gain tax is taxed at 15% and even less in some cases. If you hold the property in your SMSF for more than 1 year, the capital gain tax drops to 10%. And if you sell that property after you retire, the capital gain tax drops to 0%. So there's no capital gain tax if you sell your property after you retire. That's a massive advantage that's hard to ignore. Let's put this into a quick example. Say you personally have bought a property and sold it, and you have earned a profit of $20,000. You may lose 50% of that profit depending upon what income bracket you are in. But if you do it in your SMSF, you can keep up to $17,000, and over time, this difference can compound to hundreds of thousands of dollars. Another reason this strategy is gaining traction is leverage, because bank assesses SMSF differently. They focus on the rental income from the property in your SMSF, your super contribution, and they don't take into consideration your personal debt. So even if you have matched your borrowing capacity personally, so your SMSF could still qualify for a loan to buy an investment property. So that means you can still continue growing your portfolio even if you have already hit your personal lending limits. And taking into consideration the benefit we have discussed before, I would like you to comment in the video below. Would you like to use your super to buy the property, or would you like to keep it in the managed funds? And next is how the SMSF strategy actually works. A self-managed super fund, or SMSF, is exactly what it sounds like. You manage your own super. So instead of your employer contribution going into a retail super fund like Australian Super, REST, MLC, you roll them into a super fund that you control. So your SMSF can have up to 6 members, you, your spouse, or your family member, all pulling in their supers into a fund that you use to buy assets like real estate. So here's a simple example. Let's say you and your spouse have got $80,000 each in your account. So that's combined $160,000. So you can use this $160,000 as a deposit to buy an investment property of worth $400,000 to $500,000 using an SMSF loan. To set it up, you will have to work with two key people: your mortgage broker, who will advise you how much your SMSF can borrow, and your accountant, who will handle the setup, like corporate trustee, trust deed, or bare trust. Setting up SMSF could cost you from $2,000 to $4,000, and it takes roughly 4 weeks to complete the setup. And from there, your SMSF will have its own bank account, and all the income, expenses, and contribution will flow through it. It's a little more work than your traditional super fund, but the control and the potential upside are worth it. Coming to the next section is the rules you can't afford to break. Now, this is really very important because SMS investing is so powerful, it comes with strict compliance rules. So, rule number one, you can't live in the property or use it personally. It must pass the sole purpose test, meaning it's there purely to provide benefits for your retirement. Even staying for 1 or 2 days in the property which you have bought under SMSF can breach the rule. Rule number two, no renovations or developments in SMSF. You can maintain your property, but you can't do subdivision, add a granny flat, or add any more rooms because doing that can result in breaching the SMSF rules and can attract penalties. Rule number three is arm's length transaction. What does it mean is everything needs to be done at fair market value. You can't rent your property in SMSF to a friend at a discounted price, and you can't buy a property from your relatives in SMSF at very discounted price. Everything needs to be done at market terms to make sure your fund is benefiting properly. And one more, deposits are usually 20% or higher, and the interest rate could be slightly higher than your standard loan. So, something to keep in your mind when you are running your numbers. These rules might sound strict, but they exist to protect your retirement fund and make sure it truly serves your future. So, the next one is how to build long term wealth inside your SMSF. Now, let's tie it together what really matters long term wealth building. Imagine you have got $100,000 in your super and you left it in your super. In 15 years, it could grow up to $150,000. But instead of that, if you use that $100,000 to buy a property of worth $300,000 in your super, that property might double up in 15 years and it will be worth $600,000. Even after repaying your loan and accounting for the capital gains tax, you could walk away with $320,000. That's more than double the growth of your passive super fund investment. So that's the power of leverage and compound growth working together, all in tax efficient structure. And remember, once you retire, any rental income and any capital gains which you make could be completely tax free. So that's what makes it one of the most smartest and underutilized strategies for long term wealth in Australia. So, to wrap up, investing in real estate through SMSF isn't for everyone, but for many Australians, it is an incredible way to take control of your financial future. It offers the freedom to choose your assets, take benefit of lower tax brackets, and build real and tangible wealth that supports your retirement goals. So, if you are considering it, talk to a trusted mortgage broker or an accountant who specialize in SMSF, or reach out to us. We will help you map out the right strategy for your situation. Thank you so much for watching this. If you got value from this, make sure you like it and subscribe and share it with your friends. And make sure to comment below, would you rather invest your super into property or keep it in the managed funds? Because your thoughts may inspire someone to take control of their financial future. And I'm John Sasdev from Admire Property Group, and I will see you in my next video.